Welcome to this episode of the Coronavirus Freight Market Update for May 12th, 2020. My name is Kevin Hill. As always, over here is Michael Vincent.
Thank you, Kevin. Welcome, everybody. This is our bi-weekly coronavirus news and update market conditions show. It's interactive, so we welcome your viewers to send in questions. We'll hopefully try and get those answered for you on the air. And who do we got on the show today, Kevin?
We have an exciting show, right? So we have our research analyst, Andrew Cox, leading us off with the news headlines on FreightWaves.com, followed by our market experts, Zach Strickland, talking about the great debate and the freight markets and a little bit of earnings, as well as Anthony Smith, our lead economist, coming on to talk about economic numbers. And then we have another freight economics person, a special guest on the line, Jason Miller, Dr. Jason Miller from the Eli Broad School of Business at Michigan State University, followed by Steve Ferreira from Ocean Audit to talk a little bit about China tariffs, China-U.S. tariffs, and a few other topics. And then we'll round it off talking about last week at FreightWaves Live at home.
Yeah, right.
And what we have coming up on FreightWaves TV coming up soon. But first, as always, this is the Coronavirus Freight Market Update. So let's talk about the numbers. It's been a little while since we've been on air, since we did the conference last week.
It has. Last time we were on was the 30th, if you can believe it.
April 30th, yes.
It was the last time we were on. And when we did that, the U.S. coronavirus case count was at 1,066,000, and now we're at almost 1.4 million, 1,387,407 to be exact, as of this morning. And deaths were at 61,797. Now we're at 81,909. When we started this in March, 6,300 cases, 110 deaths. Some trends, though, that are looking good. Of the world closed cases, the death rate was at 83.67% back in March. Now it's down to 15.79%, which is really good. And the recovery rate is at 84.17%. So that's pretty good. And of the world, that's good trends, anyways. The world active cases, it's down to 98% are now mild conditions, and only 2% are critical.
That is very encouraging news.
Which is encouraging. Those are encouraging news. And daily news cases have been down since May 1st, trending down since the 1st. The death rate has also been coming down since the 5th, nowhere near where we want it to be. It was 1,000 yesterday. And this has caused the total death a curve or projection is actually at 137K now, 137,000. It almost doubled from, it was down to like 60 at one point.
At one point it was. I think about 47 states now are expected to reopen in some limited fashion by this Friday, May 15th. Tennessee, we've kind of reopened over the last couple of weeks, and I saw a headline today from the local newspaper that we are at pre-crisis movement activity.
Really?
Yeah, I saw that. Yeah,
we're already at pre-crisis activity?
I don't know if I really buy we're quite that active, but
there's a lot of activity.
This weekend there was a lot the out, restaurants, Mother's Day, of course.
Maybe pre-lockdown.
Happy belated Mother's Day to all the mothers out there.
Yeah, maybe pre the mandate.
Pre-mandate, yes.
Yeah,
probably, yes.
That would probably...
Not pre-crisis, pre-mandate.
Wow. Freight levels are through the roof.
I know.
So who do we got here? Andrew Cox
We have
first?
Andrew Cox coming up. We have an update on AB5. It's going through the courts right now, and we have that story up. I think John Kingston wrote it on FreightWaves.com. Andrew, what's up with AB5 right now?
Sure, Kevin. So AB5 is the law passed in California that aims to restrict the use of owner-operators and restrict the use of contractors. This has been blocked by court action since it was implemented on January 1st by the California Trucking Association. This has been an ongoing battle. Now the CTA, the California Trucking Association, has been spelling out why they believe the injunction should continue. They are in the appeals court, or the appellate court right now. They haven't added any new arguments to why they believe that this should be extended, but they have, the slower slower pace of the appellate courts does give their lawyers some more time to create their arguments and defend them. One thing that throws a little wrinkle into this whole argument here is that since they put the first injunction down on January 1st, the Teamsters have actually joined the side of the suit with the state against the CTA. So it will be an ongoing battle. Back in January, the CTA noted that they did think there was any way that this law wouldn't eventually get passed in California, but they have gotten the extension up until this point, and they're looking to extend it further.
So Andrew, my understanding is that, and it's in Kingston's article. He did write that, and it's an excellent article as usual from John. But the core argument really, or the argument from the CTA, is the interpretation of the line of you can't claim someone is an independent contractor unless the services they're providing is, I guess, materially different than your core business, correct?
Yes, that's correct. It's going against I believe it's called the F4A law that's been in place in California. There's been long-standing hostility from the California legislature towards owner-operators, and this is just, again, a continuing battle. I'll have to read more, and we'll bring back more to you on it.
Yeah, because so that F4A is part of legislation from like 1994, I think it was, Kevin, and it says that the state can't legislate anything that would involve price, routing, or services, right? And so the CTA is claiming that if they can't use, or if their current use of independent contractors is against the law, they would have a difficult time flexing up to meet peak demands and offering different various special services, I guess, is kind of the core argument there.
Yes.
Which is interesting.
Yeah. And we have Frank Thrasher. I think both of these are from Facebook. Frank Thrasher, hello, fellas. And Travis Kuhn, hello as well. So what's our next headline that we have coming up here? Andrew?
Yeah, the next headline, Kevin, is about the cost of workout equipment during this time of pandemic. Similar to the supply chain disruptions we saw in the grocery stores, whether it be from toilet paper or even some of the food goods like meats, we saw a surge in demand that threw wrinkles through the supply chain. We're seeing the same thing in at-home workout equipment. Research in markets.com states that demand for workout equipment at home has surged 170% year over year during the lockdown, and this surge is causing an imbalance in the supply chains all over the country. And in order to expedite delivery and to expedite production, companies like Peloton, who make the at-home bicycles, the quite expensive ones, they are incurring higher costs to try to get these goods to the consumers' hands, which it will eventually cause higher prices for those consumers.
I wonder how Peloton stock is doing through all of this. 170% increase in home fitness equipment. You probably don't know what their stock is trading at right now, but I'd have to think that's bullish for Peloton, correct?
Yeah, that's exactly right. Peloton's actually done pretty well through this lockdown and coronavirus. I don't know exactly what their stock is up now, but yes, they've been positioned really well to take advantage of this. Not only do they have the bikes and other workout at-home equipment, but they've also rolled out a digital plan through just an app in which you can work out in front of it that they're having some success with.
I think with the lockdown being lifted a little bit and people getting outside, that backlog of demand will probably ease a little bit with people getting out, being stuck at home, bringing these things in, right?
Oh, yes, definitely. Everyone is ready to get outside.
Yeah.
Ready to go to the park, to anywhere to get some great summer weather that we're having throughout the U.S. right now.
So we're not ready to call exercise equipment the new meat.
No, we are not.
Okay.
Yeah, we are not. I think there's plenty of ways to exercise without exercise equipment, right?
Gotcha.
And our next headline says a little bit of bad news. A Colombian airline has declared bankruptcy, and this is from Eric Kulich. What do we have there, Andrew?
Yeah, that's right, Kevin. Colombia's flagship airline is filing for bankruptcy. This is Avianca Airlines. They're the second largest airline in Latin America. They've got 76 destinations in 27 countries. Much like the rest of the airline industry, the Avianca saw their demand quickly fall to near zero. They ended up canceling all passenger flights domestically and internationally late in March. They kept their cargo operations going, but they saw revenue decline 80% in the first quarter. So they said they must file for bankruptcy to preserve operations and preserve as many jobs as they can. And this is because they have to address over $5 billion in obligations that stem from leases and also new airplane orders.
And something that we really monitor our TSA passenger check-ins, and we have about 200,000 passengers a day right now. I don't know if Mother's Day that weekend kind of bumped it up, but it's basically doubled off its lows of just under 100,000 in mid-April, but it's still 92% less than it was a year over year for May 10th or May 11th of last year, even with that doubling off the lows, right, Andrew?
Yeah, you're exactly right, Kevin. If you look at it on a long time series, you can't even tell the difference between last week and this week. But if you look at it on a shorter time series, you can see that they have doubled to about 200,000 per day last weekend. But I actually think that there was a Mother's Day bump there. I think we'll see things return, fall down a little bit here in the next couple weeks. But yeah, you're right. They're running at roughly 10% capacity right now. We hope that we see things pick up for the airlines later on. But these are things that we've noticed throughout the FreightWaves Live, is that structurally airlines may have changed for the future. I mean, the way that we're operating with Zoom and with other teleconferencing, it just doesn't seem like all of those airline business miles that were there pre-COVID are going to be there afterwards.
So these numbers here, does that put American-based airlines at risk as it did for Avianca?
Most certainly. I mean, Kevin and I, those TSA airline numbers that we were talking about are American flights. So the fact is that 10% of the regular capacity is being run right now, or is being operated currently in the environment. So yes, I'd say that there's no doubt that American Airlines are, not American Airlines specifically, but American Airlines in general are at risk.
I think the CEO of Boeing came out yesterday and said that he expects at least one major U.S.-based airline bankruptcy coming up.
I mean, you saw Delta canceling how many?
Like 90%.
The destinations are just not going to.
Yeah, exactly right. So that's troubles in the air sector. We also have troubles or lower volumes in the railroad sector as well, don't we, Andrew?
We do, Kevin. Not quite as bad as 90% reduction in demand, but demand is really bad. This is likely going to be one of the worst years on record for the rails. They're expecting now at this pace that we'll have a 15% reduction in 2020 rail volumes compared to 2019. Currently, rail volumes were down 22% in April, and that decline seems to have stabilized, but I read a note from Stifel today on the rails that even the first week of May was an even further reduction from the last week of April. So it hasn't quite stabilized. It's nearing its bottom, but we're still running 20+% year over year under on the volume side.
Very good. Well, thank you so much for the news headlines. You can always find all of these stories and much more on FreightWaves.com. And
Thank
now
you,
we are going to bring in Zach Strickland, our Director of Freight Market Intelligence, and we're going to talk about freight volumes and also last week, Michael Vincent, right? The Great Debate.
The Great Debate.
Yeah. Tell us a little bit about the Great Debate, Michael. To set up that.
Well, it was the debate, I guess, voting to see who's got the more accurate view or who agreed more with their view on where we're going and the recovery of the freight markets, right? Mm-hmm. It was all centered around the 9,300 volume mark for May 15th. Which by May 15th, but I guess that has been extended, right? He's got to hit 9,300 from May 15th through the end of the month, Zach, is that right? It's
9,300. We just did an arbitrary number right here on the show, whether or not, 9,300 was supposed to be hit by May 15th. I took the under, he took the over, and as of today, we are over 9,300 already. So he's a few days early. We actually talked this morning about this, and I will admit that I am a little shocked that we have hit this number so quickly after bottoming around mid-April and about that 8,600 OTVI level. Volumes have recovered quite quickly. We've seen some erratic patterns in the way that shippers are moving their freight now. They do appear to be coming online a little bit quicker than we anticipated. I mean, Craig obviously would say that he anticipated this from the get-go, but it's still yet to be seen how quickly these volumes are going to recover. We could be seeing this intermittent wave, which is one of the things I pointed out on our custom shipments that we saw come in from China as the recovery and the imports really drove a lot of that freight movement, but they've since died off quite a bit. So it's still yet to be seen that by the end of the month we see this recovery in full effect. But I do, at this point, I'm actually kind of seeing that the market may be recovering quicker than I anticipated.
Oh,
wow.
Wow.
Yeah, our next guest, Jason Miller, will talk about demand for manufacturing. He's a little bit more bearish than we are on that. What are your thoughts really on demand?
Yeah, I think that, to me, it's kind of like when you're starting the engine back up, you start to kind of hear the things turning around, and it takes a big surge of fuel to get everything going. I think that's what we're seeing right now. I think we're seeing that initial kind of crank the engine. Demand is still, it's still there in the United States. You go outside and you see people are out. They're at Lowe's and Home Depot still. They haven't stopped doing that. I still don't see a lot of toilet paper on the shelves. So we may be seeing this, scenario for a while. Now, is it a V-shaped recovery? No, it's not. We are still, well down year over year. We're roughly 3.5% down year over year. And if you remember last year at this point in time, we had just had a big trough, an unusual trough in volumes, because after the Trump announced that he was going to continue the tariff with China, we saw a big about 4 to 5% drop in volumes after that announcement. So it really hit the freight market hard. So we're still in recovery mode, but it is moving up a little bit faster than anticipated, especially on the manufacturing and industrial side.
One thing that stuck out to me, Zach, was when we were watching the volumes go up and looking at that, the freight volumes, the truckload volumes specifically moving up were mostly long haul, and then you saw some of the tweeners, right? What is it? Above 800 and then 450 to 750. But now we're starting to see and the mid haul started coming up, and now we're starting to see local and short as well kind of join the party of increasing in those volumes. So would that be a case of we saw the DCs replenishing, but then now as we're opening up, we are seeing that consumer demand that is pulling it out through the local?
Yeah, I think that's absolutely fair to make that assessment. I generally look at all lengths of haul when I'm trying to figure out what kind of freight is moving. Last week when we were doing the great debate, it was mainly long haul freight that was moving, and that short local haul freight had yet to come back online. That short haul freight was really what had driven most of that March increase. And that tends to be that more distribution center to retail center, storefront type movement. Whereas the longer haul freight comes from Los Angeles, goes to New York, goes to Chicago, goes to Atlanta. That's really where all the DCs are. So, when we're seeing all of them come back at the same time, that means that the engine actually might be turning over a few times.
Gilbert Hercules says, I lost shares in Avianca. So the bankruptcy probably didn't go very well for him.
Wow.
Also, Travis Kuhn, thanks, guys, following your updates. He works for a vendor for Home Depot, shipping coordinator of Essential Freight. And then Gilbert Hercules again says they need to open the market. So talking about Essential Freight, Zach, what are your thoughts on that movement as it progresses along?
You're talking about Essential Freight in terms of the medical supplies and food and beverages?
Yes.
Yeah, I think we're going to continue to see that. Now, the big question with the Essential Freight in terms of food and beverage is just how quickly we can transition, back and forth between this restaurant, commissary style supply chain movement versus the fresh grocery store type movements. A lot of that supply chain has been redistributed and repositioned to service more fresh food like the grocery stores, et cetera, and the restaurants have been kind of muted for a little bit. Now, restaurants are starting to come back online. It's still yet to be seen how quickly those are going to come back online in that, in the near future. Of course, we're about to hit that big push where we see a lot of food and beverage, in June and in July due to the whole summer month thing. A lot of Gatorade, a lot of water movement. Anybody that's been brokering freight for a while knows that a lot of those beverages and those plastic liquids moving across the country can drive a lot of volume in the freight market and also a lot of volatility. So I still think that will resume. So I still feel pretty good about a lot of the food and beverage sector.
Excellent. So we have earnings report. YRC specifically, Zach, you got any insights there for us?
Yeah, I mean, this is actually really interesting to me that YRC managed to turn a profit amidst the, even though I know that we haven't fully recognized the entire impact of coronavirus on some of these companies yet. March, of course, was not necessarily a terrible month. April, even they stated in their earnings, they saw about a 24% decline in volumes in the month of April, year over year, which does not reflect into these earnings reports. But they did turn a profit, a 97.10 OR, which means that for every dollar they spent, they got almost 3 cents back. This is unusual for them in the recent past or recent history. They haven't been very efficient on their operational side, and they seem to have done that through, transitioning how they spend money on the operation. Some of that cash is not being floated into the operation anymore. They're leasing equipment versus purchasing it. This doesn't necessarily hurt or impact the OR, but it does change the way their balance sheet is lined up. But they did see a decline in revenue, a decline in revenue per shipment, and yet they still were able to, eke out a pretty decent profit considering the circumstances or the environment that they're in.
That's amazing, because we've seen others that were really impacted by the dropout of certain industries and really changed their freight mix, but they were able to weather that storm. I guess from their size and the geography that they cover, they are nationwide, right?
Yeah, they're nationwide. Something that stuck out to me was that their weight per shipment really didn't change as much as a lot of these other LTL carriers did. It only dropped about 2%. Versus some of these others that we saw these dramatic changes up and down in terms of weight per shipment. So it appears that their freight mix might have been more stable throughout the month of March, which is probably what contributed to a lot of their gain.
Well, thank you very much, Zach Strickland, for all those great insights. Again, Zach is FreightWaves Director of Freight Market Intelligence.
Thank you, Zach.
Yeah, and for more earnings, stay tuned with us at 2 p.m. Eastern Time. Andrew Cox and I will be going over some trucking earnings and great quarter guys.
Cool.
Yeah.
Excellent. Who we got up next?
Next is Anthony Smith, our lead economist here at FreightWaves, talking about job numbers, specifically driver jobs today. How is that looking, Anthony?
Not too good. I think the latest reports show that there was a decline well over 80,000. When we're looking at transportation specifically, the thing to take note of is when we're looking at this, it also takes into account a lot of the office workers as well, so not just drivers specifically when we're looking at overall transportation, but drivers have been hit particularly hard, especially when we're looking at rates. We're looking at drivers being able to make money on these loads going throughout the nation. They're not able to really kind of make those margins as they used to be, and so they're really getting hit hard here.
And that was what, 88,000 job losses? Is that on the trucking side? That's not driver specific though. That's in the industry itself.
Correct, yeah. So that's looking at the industry itself. And so that really goes to show that throughout the entire industry, not just the drivers, but the entire industry is really getting hit hard, and that no one is really fully immune when we're looking at this, especially when we look at transportation. A lot of times when we're looking at overall GDP and the overall economy, I like to look at it separately from transportation, but when we're looking at this, it's really showing that everyone's getting hit hard. Of course, when we're looking at those that are able to really kind of keep things moving, when we're looking at essential goods or those being able to utilize goods that are being taken or hauled throughout the country, maybe they're being a little bit more insulated, but really as a whole, it's hitting everyone.
Yeah, so Anthony, as we go through the path to recovery, what should we be watching for? We speak about this quite a bit on freight forecasting. What are you watching? What are you seeing? Are you seeing any reports come out that are encouraging or discouraging, or what are you seeing?
Sure. So when we're looking at the path to recovery, specifically on the employment side, I think the one that's gotten, of course, the most attention because it's the one that's been the most volatile as of late is, of course, initial jobless claims. One of the areas that everyone's really been watching closely before the initial jobless claims was weekly claims, and that's going to look at the 4-week moving average. And luckily, we've seen this starting to come down a little bit in the most recent weeks. The other one, I'm going to keep hammering on it, is going to be continued claims. That one's going to be something to watch. It's going to be one to really monitor closely as we look for the path to recovery. When we're looking at continued claims, this is going to show how many people are still continuously applying for unemployment benefits as opposed to those that are initially applying.
So when do those numbers come out? When do we take a look at those, Anthony?
So the continued jobless claims come out on Thursday as well, in addition to the 4-week moving average. And so it's all lumped into that same release. It's just that initial jobless claims gets the headline item, because that's going to be the one that spiked up and has had over 30 million individuals that have applied continuously over the last 7 weeks. And so we're looking at what to really kind of pinpoint. That number, the initial jobless claim number, is going to get a lot of the attention, but keep in mind that the moving average is coming down. Although it's still quite elevated, it is starting to come down, so we're starting to see some declines over the last, we're looking at the running 4 weeks. Also, we're looking at continuous claims, that's still elevated. That's going to be a week lag, although it's still released on Thursday. It's a week lag, so it's not as an attractive number as many would like, but it is one to watch when we're looking at recovery, especially on a state-by-state basis.
How about on those regions? What's your sense of going forward, regions or state by state? What areas do you think might recover quicker than others?
Sure. So we're looking at state by state. Of course, we can talk from our own anecdotal experience here in the southeast in Tennessee. We're starting to see a lot of action here. Just looking around town in Chattanooga, it's almost as if nothing's ever happened. I mean, we're starting to see a lot of restaurants kind of come back online in certain capacities, although it's limited. But we're looking at states coming back online. Of course, we're going to start to see more, I think, in the Midwest, in the South regions, parts of Texas. It's going to be, I think, more so even within states regionally before it's even statewide, as many local officials kind of assess the localized conditions for their residents there. Of course, I think when we're looking at New York, they're going to be one of the last to kind of come on fully online. Florida seemed to make some type of progress here. We're looking at jobless claims. California is also still getting hit hard, but starting to see headlines of piece by piece of different regions start to implement manufacturing, starting to come back online for different sectors. So it's definitely going to be a piece by piece movement, and even within each individual state, it's going to be a city by city wave.
So, Anthony, are there consumer confidence numbers there, or you have any views on that, on where we are in the demand side from the consumer?
Yeah, and so, I mean, we're looking at consumer confidence. It's an area that I always like to watch, much to the chagrin of Zach Strickland, but I think it's an important one to watch. And when we're looking at consumer confidence, there has been some increase for the consumers when we're looking at the 6-month outlook. And this is a little bit of a surprise for a few. So consumers are feeling a little bit more optimistic about the recovery and the reopening of the economy in the coming months. And so that's something that could be a little bit of a mixed bag. You know, I'm happy to see that consumers are a little bit more optimistic about the outlook. Are they a little bit too optimistic? I don't know. Is that such a thing? It might be. Only time will tell, really. But we're looking at consumer confidence. Of course, it's still relatively low for current conditions, but the expectation is that things are going to really ramp up quickly. So consumers are feeling confident and optimistic, seemingly more so than expected with the outlook. I think it actually moved up when I don't really keep up too much with international consumer confidence, but I believe Australia ticked up slightly and Canada's ticked up a little bit as well. So we're looking at nationally, I think the outlook is a little bit more optimistic here.
Hi, Anthony. Let's finish on your favorite subject, housing. How's the housing market look right now?
So housing took a bit of a dip in the last month, expectedly, but the surprise is that it was still up year over year. So for those that are in housing or watching housing, many know that the spring month is really the busy season for housing, and so it's kind of difficult to see that housing starts are really difficult, having difficulties matching the demand on the supply side, and now that everything's kind of come to a halt as soon as activity starts to ramp back up. And so when we're looking at housing, it's a little bit disheartening to see that the state of everything, but there is some optimism that this will come back online as soon as consumers start to feel a little bit more stable and secure about their employment and their outlook of being able to reduce social distancing, maybe have a little bit more open houses where existing homes, as far as existing home sales are included, but housing overall definitely took a hit. but that's going to be one of the areas that I'm going to be a little bit more optimistic about as the year goes on throughout the latter half of 2020.
Excellent.
Fantastic. Thank you so much, Anthony. That's Anthony, our lead economist here at FreightWaves, and I am going to call Jason Miller right now, our next guest. And what's going on in SONAR while I do that, Michael?
Well, I think we heard a lot of it from Zach. You know, we are seeing volumes to continue to rise. Mm-hmm. They're not rising really to the level that, you know, there's going to be any real pressure or uptick on pricing or rates. Right, because your rejection capacity is still abundant, and you know the rejection rates are nowhere near where they need to be to really have any upward pressure overall on the rates. But we're seeing pockets of rising and lowering.
And I think we have Dr. Jason Miller on the phone right now. Can you hear me, Jason?
Yep, Kevin, I can.
Very good. So yes, so Dr. Jason Miller, he is an associate professor with tenure at the Eli Broad School of Business at Michigan State University. How are you doing today, Jason?
I'm doing very well. Thanks for having me on.
Very good.
Welcome, Doctor.
Doctor.
Thank you.
Doctor.
Go Sparty.
Yes. So you've been posting quite a bit on LinkedIn, and anyone out there viewing right now, if you don't follow Jason Miller on LinkedIn, please go out and do that. But you've been crunching the numbers on PMI and a few of the Fed surveys, looking at new manufacturing backlogs. What have you been seeing, Jason?
Well, so right now, and kind of the big thing is just comparing this to where we were with the Great Recession, is the April numbers, the ISM PMI was actually a little bit better than expected, but that's somewhat was by the fact that the HS market and the Federal Reserve lenders were a little bit more bearish. But basically, the big thing that we saw was April, the amount of new orders showed the largest month-over-month drop that we've seen since, before it had to be till the 80s. Now, that being said, backlog did not drop nearly as much as you would expect, given that plunge in new orders. So a lot of that's due to the fact that so many factories were shut down. The thing that I'm watching for is seeing, especially with May PMI numbers, as they'll start to come out over the next couple weeks with surveys, is do we see the new orders numbers start to pick up? And the reason being is right now we really do have a supply side recession, but if we don't start seeing those new orders start to come up, then that's going to start suggesting a little bit more ominous sign for the manufacturing sector.
And we have that chart up on screen right now, and you can see what Jason's talking about is this plunge in orders, and part of that is due to manufacturing just being offline. Now, what are the risks of demand returning for manufactured goods?
So right now, I think it's a couple things. One, again, just the consumer being fairly hesitant to go out and start spending, folks wanting to save up money. There's a little bit of a concern right now, I'd say, from a financial standpoint of commercial real estate. There seems to be a bubble that's built up there a little bit, so that's a concern for a broader financial contagion. To me, the oil and gas sector, hurting as bad as it is now, that's going to dramatically pull down demand for steel and metal bending companies. And the auto industry of not knowing where we're going to demand at for automobiles. That's been one sector that's been a little bit more positive news. Toyota just said that they think the worst is behind them. Some projections that automobile demand may not fall as far as we thought. So that's at least positive. Then to me, the other big thing is trade and tariff issues, especially with China.
Yeah, that makes sense. The trade and tariff issues, right, are going to be disruptive or cause some nervous tension that's going to be a little bit detrimental to the recovery. But so how do you see this, Jason, affecting really the freight market and freight demand, or the volume of freight that's moving? Because we're seeing an uptick. There's definitely a fairly lengthy recovery that's going on. It's not incredibly steep, but it's pretty good. We're back above 9,400 in all lengths of haul, and actually in all the three major modes, the dry van, refrigerated, and flatbed, their outbound tender rejections have jumped off the floor. They're not anywhere where the demand is outpacing the supply of capacity, but there's positive trends. So with these new orders and backlog order trends, et cetera, how do you see that happening? Are we in a kind of a peak within the valley and we're going to drop back down a little bit, or how do you see that recovery going?
I think right now the biggest thing is going to be we'll see. I think one reason we're seeing more outbound tenders right now is with a lot of factories starting to open up, is we're starting to see that need to get inventory positioned, and we're finally getting the stuff that was on order in March and February. We're getting that off the line. So I think that right now we've got enough of a backlog to burn through that at least for a few months we're not going to have any issue, as so long as there isn't a spike in COVID case again. So right now, a few months, I can definitely see outbound volume turning decently well. My big concern is, again, oil and gas, as that's going to pull down especially the flatbed sector. And then I think real wild card is, do we start to see, come in June, because it's going to take that long, substantial spikes in COVID cases around the country. And if that's when the really bad economic conditions will set in, because that's just going to mean we're in for a long haul of social distancing.
Now, you've also been doing a lot of work on the spot market, crunching the numbers as well. What are your thoughts on, there's a huge controversy. I know you've seen it online and through various media outlets about price gouging or paying cheap rates. But you did an analysis on the spot market rates over the last few weeks. What did you find?
So when you take a look, at least going back to 2017, at a monthly level, using DAT's load-to-truck data and then their spot price data through SONAR, is that what you observed happen to rates in April of the decline is exactly what you should have observed. So in other words, it followed the trend line very well. And so at least from a broad national market level, there's no evidence of excessive price gouging. Well, that's not saying that it didn't happen here and there. Well, I'm positive it did. But the market behaved as a competitive market should behave. We saw the floor, demand plummeted, supply stayed relatively the same, and not surprising, prices went down.
Interesting. So, one last thing, Jason. You talked about the freight movement now is really manufacturing, and factories are planning on starting up, and some of them are starting up, and a lot of that movement were already placed orders, right? Because we saw new orders plunge. We saw the backlog not plunge as much. So that would indicate that orders already placed are being filled or draining of warehouses again into the manufacturing, right? So would it be fair to say that a fairly steady, slower recovery would be less detrimental to the supply chain and cause less disruption than a quick V-shaped recovery?
I mean, I've not been one to really. I don't see how we're going to have a V-shaped recovery just because there's so much uncertainty right now that you're not going to see folks rushing out to make capital expense.
More of a swoosh, right?
Yeah, the swoosh is a great analogy. I mean, because I look at it this way. Michigan State is an example where I'm at. We had tens of millions of dollars of construction project that we were going to carry forward next year. We've frozen all of that. So there's going to be hundreds of flat nodes of construction that have just been removed. And so we're going to see the recovery isn't going to be as fast because a lot of that capital expenditure for factories, for construction, I mean, every university in the United States is basically holding their construction effort. That's going to have a carry through and it's going to slow things down. So the swoosh recovery to me is the likely scenario. Again, assuming we don't have a massive outbreak cases take place in a month.
Yeah, very good. Yeah, what I was getting at and kind of talking to was that we're almost forced into this swoosh, and you've put more evidence behind that outlook or that prediction of a more swoosh type recovery. My point was that even if it was the demand was there for a V, the supply chain is not going to be able to handle a V-shaped recovery to any certain magnitude.
I agree. There's no way. It's much easier to turn an economy off than it is to turn it on.
Right. Yeah, exactly.
Well, thank you so much, Jason, for your great freight market insights. And again, Jason Miller, assistant professor with tenure there at the Eli Broad School of Business at Michigan State University. If you're not following him on LinkedIn, please go do that. He's always thrown up some of those great charts that we saw just a second ago. Thank you again, Jason.
Yep, thanks so much, Kevin.
Thank you, Jason.
Always a good perspective. A little bit of economics, a little bit of freight demand, economic demand. It's always interesting.
It is, and it's very important to understand those dynamics between those macroeconomic indicators and what's actually happening on the road.
And you know what? Throw in another variable into this, that's our next guest, Steve Ferreira from Ocean Audit.
Is he the X Factor, Steve?
He's the X Factor. You throw in the international maritime ocean trade freight in that, and then you have a different equation altogether. So I think we have Steve ready joining us via Skype here.
Hi, Kevin.
In just a sec. There he is. How are you doing today, Steve?
Hey, it's great to see you guys. Thanks for having me.
Hey, Steve, welcome.
My pleasure.
Thanks for coming on.
Oh, it's my honor.
Yeah, and just give us a little bit of an intro for yourself.
Oh, sure. I'm Steve Ferreira, CEO of Ocean Audit, and Ocean Audit serves 16 of the Fortune 100 on cost recovery services having to do with ocean freight and international logistics. So been quite active, obviously, in COVID-19, as many CFOs. Obviously, cash is king, and it's a great time for securing recoveries for all the great clients across America and the world. So that's a little bit about me. And as I said, pleased to be here.
Very good. Pleased to have you on. We're going to talk a little bit about international trade and China-U.S. tariffs. Will there be a trade deal? Will they pursue a trade deal? What exactly is going on with that right now?
This is, in my humble opinion, I'm looking at this every day, at the numbers, at the political ramifications, and I truly believe that there's a paradigm shift in progress. One of the most interesting things that you'd ever want to study is the Ocean Audit statistics on this particular issue. I tracked over 650,000 ocean invoices in the last 5 days coming into America. That's the single largest number I've ever tracked in about 5 years. Now, there's a couple of reasons for that. On the flip side, before we get into that, China has definitely not lived up to their phase one obligations. January to April 2019, we exported 500,000 containers. This year, the same time frame, 250,000 containers. So the Chinese are definitely not buying our ag. They're definitely not buying our exports. But yet we're still force feeding ourselves on the low value type commodities that China is producing. There's a couple reasons for that. One is that we may be at the new start of a forward loading based on potential retaliation by Trump and the administration on China and COVID-19. Very shocking news, obviously, in the last 24 hours. Trump's Rose Garden press conference yesterday, where he had a confrontation with a CBS reporter over China, and she was a Chinese-American journalist, and also the U.S. Trade Representative putting out a broadcast in New York Times that we need to really reduce our America needs to reduce the amount of offshoring they do. So I am stunned by the fact that we're still bringing in so much material from China. I think it may be a opportunity for purchasing executives and materials managers to do a little forward loading. Also, I think that there's a little bit of panic that, hey, if we're not ready to move from China, we need the material in, at least in stock. So we're in a really interesting phase right now, gentlemen.
It is very interesting, and it'd be very interesting to see how this affects our recovery, right? With the uncertainty with those tariffs, and I guess people started to diversify their supply chain, their international supply chain specifically, with the tariffs and the threat of trade war, et cetera, previous to COVID-19. And now we're seeing it ramp up again, right? So it's just going to speed up that process and cause that process. And it's no simple matter to diversify your supply chain domestically. Then you toss it into internationally, and it's just, it's unbelievably difficult and complicated to change those supply chains. You just can't do it, right? So are you going to see more? Are we going to see more of that type of thing due to these impending tariffs and this new kind of trade war that's emerging?
Well, we talked about it a little bit on my OK Boomer TV Live, LinkedIn Live channel last week with Dan Gardner. And one of the things that we talked about was the fact that there is a real big difference between, going offshore and sourcing material and really planning for the next 5 years of sourcing. And so I think that, if you look at the U.S. Free Trade Agreement, with 20 countries, Mexico, Costa Rica, Caribbean, I really do think that the timing is right for a lot of changes to take place. And one of the things that also you have to take in consideration is a lot of people are now starting to play a bit of game with the $800 customs exemption. So in other words, anything that comes in that's $800 or less in value, right, there's no duty, no tariff from China. So go back to my statistics of 659,000 invoices coming into the USA. I don't have the number, but a large percentage of them are small shipments, right? The fulfillment by Amazon replenishments, where the FOB value is below 800. So there's a lot of material coming in that's not being tariffed and dutied. And our big concern is that, even if you're dealing with a Chinese manufacturer that's offshoring the production to Vietnam, could we ever be in a type of political situation where it's forbidden to work with a Chinese vendor, no matter where they're located from the country of origin? So there's something heavy that's going to come down. I don't know if tariffs are the answer, but I do think that one of the reasons why we're seeing such volume now coming in is a bit of panic. It's a bit of obviously post-COVID-19 hangover in China and recovering. And it's a bit of, I think, blinders that the American public has in terms of the fact that everything will kind of go back to normal with China. I don't think that's the case at all.
That's really interesting. And so, Steve, do you see a pressure to, I believe what you called non-tariff trade barriers in North America, meaning freer trade between Mexico, United States, Canada, the pressure to move that forward based on these type of situations?
Well, it's interesting. If you look at places like where the next, McKinsey or Boston Consulting Group, or people that are in the know, they'll look and say, okay, where is the next big China? And so then the natural instinct is, okay, it's India. But India, for example, just doesn't have the infrastructure. India is a democracy. They're way behind China in terms of any kind of normed infrastructure to compete. And just as an example, China had 659,000 invoices. India had 60,000. So 10% of China. So I think that the movement, and in talking to Professor Dan Gardner, who I partnered with on our first talk on U.S. trade with China, it seems that Mexico, other countries in the free trade agreement, would be natural beneficiaries, as well as, and this is the important factor, the cost of wages in China for a labor-intensive item to manufacture it is about $3.50, and of course here in the U.S. it's $20. So I think that if you look at the hierarchy of valuation of goods, like nail clippers or fingernail files or whatever it is, we'll probably never be able to get away from China on those low production goods. But anything that's high value, building automation, machinery, air conditioning, and whatnot, I think you will see a gradual shift, just like the automakers have successfully done, to Mexico and other countries in the U.S. Free Trade Agreement. And I think it's a really important point that, listen, my role is to get refunds for clients that ship from China. So I'm a China fan, but at the same time, I see the writing on the wall that we may be in a type of political situation where no matter what you are in a business environment, this may be too overwhelming for you to deal with as a business executive, and it may force your hand to move to Mexico.
Hi, thanks, Steve. On a side note, that's a great propeller. Yeah, I mean, your entire background there in your home office is awesome. What does that propeller go to exactly? Do you know?
The propeller?
Yes, behind you. The other side. The propeller.
Oh, that's actually I hired a designer from Wayfair to equip my home office, and that's one of just the tchotchkes that she selected. So it has no real bearing other than it looks good. I'm just being honest.
Nice.
That's why Wayfair stock is way up.
Yeah. There you go. And you have a new show out on LinkedIn and social media called OK Boomer, right?
Yeah, OK Boomer Live. It's me as a 59-year-old boomer working in a world of millennials and Gen X's and coexisting, and we have a lot of fun sharing thoughts on both supply chain, logistics, branding, social media, and selling and marketing. And I really love the space that I'm in. I thank FreightWaves and LinkedIn for allowing me to have the broadcast rights to do these kind of creative ventures. I was really glad to be part of FreightWaves Live with the interview with Elaine Pofeld. And, I think that this is a niche that more and more Americans need exposure on. So I'm certainly glad to be talking to you today about it.
And where can they catch your next OK Boomer episode, or when, I should say?
This Friday at 1:30 Eastern Standard Time, we'll be having a segment, an emergency segment on the 3 big red flags that you need to know about if you're shipping ocean freight. So it'll be a can't-miss event for finance and logistics and supply chain finance professionals. So Friday, 1:30. On YouTube and LinkedIn Live. Just follow Steve Ferreira, and you'll have all my broadcasts.
Thanks again for your time today, Steve. It's always a pleasure.
Thank you, Steve.
It's my honor. Thank you. Bye, guys. Thank you. Bye-bye.
Bye. And talking, he did an excellent talk on last week at FreightWaves Live at Home, our 3-day event, and it was with Elaine. I can't pronounce her last name, but excellent book. I ordered it. I'm still waiting on it. Amazon, it's not 2-day delivery anymore. So
it's sometime in a not too distant future. Could be a day, could be 6 months.
It could.
You just don't know what's going to happen.
But
very interesting
awesome
stuff.
Time.
Great insights from Steve. And everybody at FreightWaves Live at Home.
Yes.
There's no doubt about it. But
it was great, and you can find that streaming. If you didn't catch it last week, you can find it streaming at tv.freightwaves.com.
You absolutely can. Absolutely can.
Yeah,
so
we have all the segments cut up for your consumption.
Yeah, absolutely. So should we end on a good note here?
We should, yes. Let's
Not
do
that any of that was bad. It was very interesting. But
the news has gotten better week by week.
Thankfully.
Thankfully,
and
yes.
I've said this before, right? Every time we're preparing for the show, I say, won't it be great to do the last one? Yeah, it's over. Yeah. But so Motel 6, listen to this, is partnering with Trucker Path to offer a discount on room rates as a way to say thank you to truck drivers hauling essential goods during the coronavirus pandemic. Motel 6 is offering a 12% discount to truck drivers who book a room at one of its 1,400 hotels through the Trucker Path app. app. Since the onset of the global pandemic, the hotel chain said it has launched enhanced protection protocols for guests and employees at its locations so drivers can feel safe no matter where they stop along the road. Truckers can find and book rooms at Motel 6 locations along their routes by downloading the Trucker Path app. Good news to see people.
That is awesome. It sounds like Motel 6 is leaving the lights on for truckers.
Oh, man. You are so... That was... Are you a dad? You should be. Are you a dad?
I know. That was a perfect dad joke, wasn't
it? We'll end it on that dad note, right?
Yeah.
So what do you got coming up on Great Quarter, guys?
We are going to talk about earnings, and it is going to be U.S. Express and I believe Uber Freight. We're going to cover those two earnings. I think Anthony Smith is going to join us for a little bit, and we're going to talk about jobless. We're going to really jump down into the weeds on jobless claims and unemployment going forward, and that's at 2 p.m. Eastern Standard Time right here, whether it's LinkedIn, Facebook, YouTube, or FreightWaves TV.
Right on. And you got Put That Coffee Down tomorrow at noon, is that right?
Noon tomorrow. Our noon show is Put That Coffee Down. We have Bill Vitti from truckstop.com joining us, talking about aligning goals between the company and the salesperson or sales team, and kind of how that can get out of whack sometimes, and how best practices on really to align those. So we'll be talking about that, and that's tomorrow at 12 p.m. Eastern Time. Put That Coffee Down with myself and Tim Dooner. And then...
Nice. Did you got Zach Strickland and Anthony Smith on Freightonomics?
At 2 p.m.
At 2 p.m. tomorrow.
And they're going to talk about Freightonomics. Not exactly sure what, but they always dive down into some really interesting data sets and kind of map out supply and demand and how that applies to the freight markets. And then after that...
Thursday at 4.
On Thursday,
yes. Thursday at 4 is freight forecasting, and as usual, breaking down the different data elements that help you forecast what's going on in the economy and ultimately freight movements and freight markets, all different modes. So we're going to be digging into imports and the rail and some of the economic numbers that we got. So we have the PMI has come out, right? And so, or from the ISM, I should say. And then we have the logistics indicators that should be coming out, I think, Thursday. So we'll have some of those together, try and look at those things. What do the back orders and the new orders mean? But also what's going on with the different international trade that is happening out. Because we have seen imports drop, but now they're ticking back up.
They are, yeah.
They've ticked back up, and they're really close to last year's highs.
Yeah.
Which is interesting.
And that's Thursday at 4 o'clock. We'll be back Thursday at noon with the next episode of Coronavirus Freight Market Update. And going back one day, Wednesday, you're going to be on with SONAR at 4 p.m. So we're going to have
true. Yes,
Put That Coffee Down at noon, at 2 o'clock.
Yeah, I'll be filling in for Luke. So
4 p.m., you're going to be with Kyle Taylor on with SONAR, where you'll discuss everything SONAR.
And then we got the big, huge What the Truck on Friday.
Yeah, no, you already have, 4 guests lined up.
That's right.
And they're exciting guests.
It's going to be a good one. I'm not going to reveal them right now. You're going to have to look for You're going to have to look for the posts from Dooner and myself on that one there. It's going to be a great show. It's going to be a huge show.
Under wraps.
It's that good.
That sounds exciting. I'm going to have to tune in, definitely.
It's certainly that good.
Again, FreightWaves Live at Home was last week. All these great Waves talks, fireside chats, Derek Leathers, Shelley Simpson. Who else did we have?
Man.
I know, right?
Paris Cole.
Paris Cole,
on.
right?
The list goes on and on. Just check them out. They're on FreightWaves.
Yeah, FreightWaves TV. Right.
FreightWaves TV. You can go check those out. They were excellent, and it's going to be awesome because, as good as that was, the next one's going to be better.
It is going to be better. It's going to be internationally focused, too.
That's exactly right. So the one in the fall will be a virtual event, and it'll be international, global virtual event.
And that'll be September, I believe, 16th and 17th.
Yeah. If you give Craig Fuller that long to plan something...
Yeah, it might be 3 days.
It's like trying to beat Belichick or Saban. You can't do it. So it's going to be awesome.
Yes,
it's going to be awesome. Look forward to seeing everybody there as well.
Any parting thoughts about where we've been over the last 10 weeks since we've been doing Coronavirus Freight Update?
I just on a personal note, I feel better at watching these numbers come down. It's what we've been hoping for, right? And it can't get there fast enough. The numbers can't come down fast enough. We can't get through this fast enough. And I always feel strange about saying, well, this looks good, and I'm glad to see only 1,000 people died.
Okay. That wraps it up for this episode. Just stick with us, 2 p.m. Eastern Time. Great quarter, guys.